Let's talk about some business now. In the country's biggest telecom operator, Safaricom is said to lose part of a key revenue stream after the Communications Authority of Kenya cut the fees mobile companies charge each other to connect calls across networks. Now, the regulator has further outlined a 4-year plan that will steadily lower these charges. Now, this move benefits smaller operators but reduces what Safaricom earns from its rivals. Jasmine Wamboi has more.
Mobile termination rates, or MTRs, are the fees telecom operators pay each other to complete calls across different networks. So when an Airtel Kenya customer calls a Safaricom subscriber, Airtel pays Safaricom a fee to deliver that call. Because Safaricom has the largest share of the voice market, about 61%, it receives more of these payments than it pays out. That has made interconnection charges a steady source of revenue, and in the year to March, Safaricom earned 4.7 billion shillings from these fees. But that income is now set to decline. The Communications Authority has reduced the termination rate from 41 cents per minute to 37 cents effective Sunday. The regulator has also mapped out further cuts to 35 cents by February 2028, 33 cents by February 2029, and finally 30 cents by March 2029 when another review is due. As the rate falls, Safaricom will collect less money from competitors like Airtel and even Telecom. For these smaller operators, however, the lower fees means reduced operating costs and slightly improved margins,
but also exercise control over those resources.
The changes partly follow concerns raised by the World Bank in its latest Kenya Economic Update report, which argues that Kenya's termination rates are still higher than the actual cost of providing the service. In fact, a study commissioned by the regulator shows that the real cost of terminating a call is about 6 cents. This is far below the current regulated rate. The World Bank also saying that Kenya's rates are higher than those in markets such as Tanzania and Ghana, and that high termination fees tend to favor larger operators. All this comes at a difficult time for voice business. Traditional call revenues are already declining as more consumers shift to internet-based platforms such as WhatsApp, Zoom and Skype, which use mobile data instead of conventional voice minutes. And mobile termination rates have been falling for years, from a high of 2 shillings and 21 cents per minute in 2010 to current levels. For now, however, it is unclear whether customers will see a drop in call prices, as operators are yet to announce any retail tariff cuts. Jasmine Wamboi, Citizen TV.